China's securities regulator published draft rules on February the 1st to expand the registration-based IPO system across the entire A-share market. The system, which was previously on trial in Shanghai's Star Market, Shenzhen China Export, and the Beijing Stock Exchange, will now be implemented across all the main boards of Shanghai and Shenzhen bourses. The reform, which is widely regarded as one that can make China's capital market more market-oriented, comes at a time when the country has come out of the COVID-19 shadow and is back on the recovery track. According to the China Securities Regulatory Commission, the reform is a combination of the experiences gathered from the testing grounds and is being launched at an opportune time. Unlike the approval-based system where a company listing requires approval from the securities regulator, the new system empowers bourses to review IPO applications. The regulator is mainly responsible for ensuring that the new listings are in line with the national industrial policies. The registration-based IPO system also places emphasis on information disclosure. Bourses will review the materials and ensure that no fraudulent information is incorporated. In other words, what the reform does is to ensure that the China Securities Regulatory Commission confines itself to a supervisory role rather than being an arbitrator on whether a company should be listed or not. Unlike the earlier IPO approval system, the new one is more transparent as all standards, processes, and results of the vetting are available to the public. Because of the expansion, listing standards for companies to the main boards will be more varied and inclusive. For example, stipulations that the listing company must be profitable for 3 consecutive years will no longer be applicable if it attains a certain market value or a certain revenue over the past year. This will allow the entry of more companies with good growth prospects and high future returns. Another major feature is the flexible pricing mechanism. In the past, there was a ceiling for prices of new shares with price-to-earnings ratio no more than 23 times. Now, for some very promising companies, the prices can be higher. Besides, daily trading limits have been removed for IPO shares during their first 5 trading days. An improved delisting system, which will come into place after the reform is implemented, will make it easier for a company to be delisted if it fails to meet the stipulated financial parameters. All in all, the reform aims to give the right of choice to the market, or in other words, the market will play a vital role in deciding who among the fittest will survive. In layman's terms, the simplified procedures will shorten the listing time for companies, while a market-oriented A-share market will channel capital to companies with real value. The flexible standards will also be a boon for financing companies with high growth prospects, such as high-tech companies, while a transparent and efficient stock market will boost the real economy.